Hello, welcome back. This is Introduction to Accounting Part 4, the December 31st accounting party. This is our first example of going through and doing a all December 31st accounting transaction. The information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. I encourage you to share this presentation, and they'll share links to the presentation on an unmodified basis. If you do modify the presentation in any way, please email me prior to doing so at bennett1812@gmail.com to discuss. I do not claim any copyright whatsoever in any companies or organizations mentioned in this presentation. Rather, the other parties are the owners of their respective copyrights. Okay, so we're going back here to learning accounting, and we're really focusing here on doing this on a balance sheet only basis. I never give an exam using this. I'm really only focused on when it comes to doing financial statements, I'm much more focused on, things with where we're doing other ones. But when we're first learning accounting, it's really important for us to take baby steps like a baby shark. And then we come into a daddy shark or grandpa shark, but we're going to take baby steps. And as we're going through and taking these smaller steps, it's going to help us later when we're going through and having a lot more transactions to go through and record. So for these examples, all of this will take place on December 31st. These examples are completely unrealistic. However, we're doing them because we need these examples to help us better understand accounting. So this is our first example, and I'm going to jump to an Excel sheet in just a moment. But we've got Rhea and Kirsten, Kirsten, she's going to kill me, from Buck the Constellation Inc. on December 31st, 2019. Kirsten, BTCI had the following transactions that all took place on December 31st, 2019. So just give me a moment and I'll go to the Excel sheet. Okay, so now we have to go through and record transactions. We always want to look at what's being required of us. And so here we need to input all of these into the T accounts. We need to prepare a trial balance and a balance sheet as of December 31st, 2019. Notice here, if you have instructors that insist upon doing journal entries, that's great. I'm going to do a video later that shows you how to do journal entries from T accounts. It's really easy. However, what I'm more concerned for all of you is as we're going through and how do we go through and record this. Remember, the rule is, and I'll put it here in this first T, I've got here my assets are going to be equal to my liabilities plus my owner's equity. I have a debit, credit, and remember, I'm going to be recording assets with a debit. I'm going to be basically increasing my assets with a debit, decreasing them with a credit. For my liabilities and equity, I'm going to be increasing those with a credit and decreasing those with a debit. When I'm using this T theory of accounting, it has to make sense from both sides, meaning that if I'm recording a transaction on one side, it has to make sense from the other side. So here, Rhea and Kirsten are each contributing $75,000 to BTCI in exchange for BTCI common stock. We are doing this transaction for BTCI. Okay, so this is required for transactions basically, and we'll put here for BTCI. Okay, so the company, Rhea and Kirsten, are each giving me $75,000, and my company is giving them common stock. So what am I receiving? I'm receiving cash. And the amount of cash I'm receiving is going to be $150,000. Why is it going to be $150,000? It's going to be $150,000 because it's going to be $75,000 from Rhea plus $75,000 from Kirsten. That's where I'm getting this $150,000 from. Okay. And good job, Tchaikovsky, for getting us that little squiggle there. Let's go ahead and get rid of that. So this is what's getting me the $150,000. Okay, so this is where that number is coming from. They're each contributing $75,000. Very, very important to always be reading the language of this. What exactly is it saying? So our rule is for every debit, I need a credit. What's happening here is that I'm the company. I'm receiving cash, and what am I giving them? I'm giving them common stock. And so for every debit, I need a credit. So I'm going to credit common stock for $150,000. Does this make sense with our T theory of accounting? And right here, right, we've shown here we're increasing our cash by the 150. And then over here, we're increasing our owner's equity. Remember, common stock is an owner's equity account. If you don't remember that, go back to video 2, okay? So right over here of the sequence. So right over here, I'm doing this as a credit to common stock, okay? So that is transaction number 1. What a good habit to do is as we're going through and recording our transactions, is to essentially make a notation of which one it came from. That way we can go back and we can check our work. Okay, next one right here is I'm leasing building space from January 1st, 2020 to June 30th, 2020. This is in the future. Right now is December 31st, 2019. Remember, all of these transactions are happening on December 31st, 2019. So I'm making a $2,000 cash deposit. What's happening to cash? Well, to secure the space, I have to pay cash. I'm making or giving a $2,000 cash deposit. So here, my cash is decreasing. So I'm going to show this decrease to cash, right, because cash is an asset. I'm going to show this over here as a credit to cash for $2,000. Okay, so that's my credit to cash. This is transaction number 2. For every debit, I need a credit. So for every credit, I need a debit. So I know I'm going to have to basically make this right here. This is $2,000. What exactly do I want to go through and call this? Well, what this is that this is a deposit. Essentially, it's like a rental deposit. When you pay a security deposit to a landlord, hopefully you haven't trashed the place by the end of the lease, and so you'll get your money back. So right here, I'm going to call this a lease deposit, which is an asset. And so right here, I'm increasing my asset here with this debit. Now, could you have done it where you said, oh, I'm making a deposit, that's a debit, I'm crediting cash, that's fine. When you're first doing accounting, what I would recommend doing is what is the impact on cash? Cash is the easiest way to go through and see this. Remember from my prior discussion, throw out what you knew about debits and credits when it comes to cash from a banking side. You have to go through and look at this in terms of for financial accounting. Cash is an asset. We increase the asset with a debit. We decrease it with a credit. So right here, again, it's a lease deposit or an asset. If you're in my class and you call it like rental deposit, that's fine. Okay, so I'm paying $3,000 for an insurance policy that will be covering me in the future. So let's figure this out. Is cash going up or down? Well, if I'm paying money, cash is going down. How do I show a decrease to cash is going to be with a credit. Okay, so right here, I'm going to credit cash for $3,000. What am I buying? Well, I'm buying future insurance coverage, which I have not yet begun to use. Today is December 31st, 2019. I'm buying coverage in the future from January 1st through December 31st. So I'm going to call this prepaid insurance. And right here, call this number 3. And here I've got $3,000. So that's called prepaid insurance. Okay. Let's go to the next one. Number 4. Over here, and again, prepaid insurance is an asset. It's giving us future economic benefit in the form of insurance coverage. Number 4, I purchase and receive equipment for $10,000. I pay 20% in cash, and the remaining amount is placed on a note payable. So I'm receiving equipment. So the equipment I'm receiving is worth $10,000. How do I want to go through and do this? Well, I'm getting equipment that's worth $10,000. Equipment is an asset because it is giving me future economic benefit. Please go back and see my 3rd video where I go through the different types of categories. Actually, I think it's the 2nd one, where I go through the different types of categories. So right here, so I'm going to be debiting equipment here for $10,000. Okay. So the next question is, how am I paying for that equipment? So it tells me I'm paying for the equipment. I pay 20% in cash. So how much cash is being outlaid for this equipment? By the way, this is why I love accounting, because I didn't do so great in calculus, but a lot of accounting is a lot more basic math. It's great. So over here, the equipment cost me 10 grand. My equipment cost, 20% cash deposit, my 20% down payment. So my total cash down payment is going to be 10,000 times 20%. We can show this here as a percent, and I'm going to change this to go here. So here, my total cash down payment is going to be $2,000. So I here 2 grand. This is for transaction 4. Now, one of the things I said earlier is our total debits, or 10,000, which is the value of the equipment I received, has to equal my total credits. So right here, I've got total credits so far of $2,000. So if my equipment cost me 10 grand and I paid 22,000 bucks, the amount that's going to be owed is going to be 10,000 minus the 2,000 down payment, or $8,000. So, and it tells me that I made this $8,000 payment as a note payable. So what I'm going to do here is I'm going to create a new T account for a note payable. And my note payable is right here going to be 8,000 bucks. And that's how my credits are balancing. Let's go back here and make sure that this makes sense with our T theory of accounting. The first part right here is I'm receiving equipment. Equipment is an asset. I'm going to show the increase of that asset with a debit. So that makes sense. I'm paying $2,000 cash or decreasing my cash by $2,000. To decrease an asset, I show that as a credit. This remaining $8,000 I'm going to have to pay for in the future. Therefore, this is a liability, and I'm calling this right here, this is going to be a note payable. And I'm putting a 4 by that, so I know that this is the transaction that in fact relates to. So again, whenever we do these transactions, we have to make sure that it makes sense with this. This is going to help us as we're going through and recording these earlier transactions. All right, let's take a look at number 5. On December 31st, because this is when all the transactions happen, I loan $4,000 to Jenna Collette, or JCI. The loan will be repaid next year. And so I'm loaning money, meaning that I'm giving money or letting Jenna Collette borrow these funds. So if I'm giving money, my cash is going down. So that cash is going to be decreased with a credit right here. For every credit, I need a debit. I need a debit of $4,000. Okay, and so this is going to be transaction 5. What exactly is this going to be? What I'm going to call this here is this is going to be a loan receivable. E-I-V-A-B-L-E. This will be a loan receivable. Okay, so I've loaned money to Jenna Collette. They have to repay me back in 5 months from December 31st, 2019. There's no interest here. Rather, this is a loan receivable. I'm giving money to somebody else. That's what happens here. So the loan will be repaid in the future. So this is going to be a loan receivable. Now, let's look here at the flip side. Luca Luca has loaned us $30,000. We will repay the loan next year. In this case right here, somebody's giving us money. So if we're receiving money or we are receiving cash, I'm going to show that receipt as a debit. Okay, and this is right here because I'm receiving the money. I'm going to show this here as a debit to cash. But for every debit, I need a credit. So here, I'm going to credit loan payable for $30,000. So what type of account is loan payable? Loan payable is a liability. I have to repay the money next year. They've loaned me money, I've got the cash, and they're going to basically be repaying this to me next year. So, excuse me, I'm going to have to repay them next year. So they gave me money, I got to pay them in the future. So right here, I'm increasing my assets because I got that cash, but I'm also increasing my liabilities. I have to pay this money back next year. It is an obligation. Okay. My next one here is I received $7,000 as an advance from a customer. I will perform the work in January of 2020. So right here, I'm just going to move this over. So right here, I'm receiving cash of $7,000. Okay. Now, what's really important here is I've got the money and I need to, it's a customer advance. It's a liability. It is unearned revenue. deferred revenue, whatever you want to call it. If you don't remember this, go back and look at the list of liabilities that we went over in the previous chapter. So right over here, I'm going to be debiting cash for $7,000. And in this case, what I'm going to be doing is I'm going to be crediting over here unearned revenue. And this will be for $7,000. And this is transaction 7. Now remember, this unearned revenue has a credit balance. Why? It is a liability. I've received money as an advance for future work I need to perform. I have not earned the revenue yet. I haven't performed the service. I'm going to be performing it in the future. Therefore, I'm going to be calling this an advance. So I'm going to debit cash here for the $7,000, and I'm going to credit this unearned revenue. If you called this an advance from customer, and as long as you're classifying it as a liability, I'm fine with it. Okay. The last one here is I purchased $8,000 of inventory to be resold in BCI's stores. I'm going to make a little clarification here. We're going to call this on account. Okay. So I purchased $8,000 of inventory that I'm going to resell in my stores on account. So what am I receiving? Well, I'm getting inventory, which is an asset, which you can kind of go back and take a look and see from the previous video, but it's something I can be reselling to my customers, very much like Home Depot, very much like Lowe's, like Macy's. So I'm debiting inventory. Now, normally, if I'm buying something, I'm paying cash for it. I would credit cash, but this is a little bit different. When it says on account, and if I'm purchasing inventory, what that means is I'm getting the inventory, but I'm putting it on account, meaning I'm not paying for it now. So what I'm going to need to do is I'm going to credit accounts payable. I'm going to credit accounts payable here for $8,000, and this is transaction 8. Okay, so we have gone through and we have recorded all of these different transactions. We've recorded transactions numbers 1 through 8. So now what I need to do is I need to go through and I need to make sure that my total assets equal my total liabilities plus my owner's equity. But before I get there, the first thing I'm going to do is I'm going to do a trial balance. And this is what we're going to call an unadjusted trial balance, meaning that do my total debits equal my total credits? So here, I'm going to go through and then making sure that my total debits equal my total credits for all of the different transactions. But before I do that, I need to go to each individual T account and do the total. So what I'm going to do right here is for every T account, I'm going to make a total up here of the balances. The way this works is here with cash is I got $150,000 for my 2 investors, plus $30,000 from my from the loan, plus $7,000 as advance from the customer. So during the day, I received $180,000. But at the same time, I paid $2,000 for a lease deposit. I paid $3,000 for an insurance policy. I paid $2,000 as a this $2,000 was part of transaction 4, the down payment on the equipment. And then at the same time over here is I loaned Jenna Collette money. So when I add up all of these credits, I get $11,000. To determine the ending balance in this cash account, I'm going to take my debits, I'm going to subtract my credits, and I'm going to get $176,000. The next thing I'm going to do is I'm going to go through all of my T accounts. I'm going to total these up. For common stock, there was only one transaction here. To make my life a little bit easier, I'm going to go ahead and clean this up a bit. And I'm just going to pause this real quick, and I'm going to come back when I've totaled these up. I'll be right back. Okay, so we're back. So what I'm going to do right now is I'm going to total these up. Here, my lease deposit of my asset, 3,000. My equipment over here. My note payable of 8,000. My loan receivable of 4,000. And then my loan payable here of 30,000. Unearned revenue of 7,000. Inventory of 8,000, and then an account payable here of 8,000. So once I've gone through and I've totaled up all of the T accounts, what I then need to try to figure out is that do these amounts, in fact, do my total debits equal my total credits? So in order to do that, what we're going to do is we're going to make a very large T account. And we're going to go ahead and we're going to transfer these balances over. Now, what exactly is a trial balance? It's really, I'm trying to make sure that my total debits equal my total credits. And if I go right here and say I'm going to make a big T account, all I'm doing at this point is I'm going to be transferring balances over here from this different part, my cash, common stock. I'm going to put this all into the T account. Now, when I'm doing this, I want to do it in a certain way. The way I want to do it is I want to list out my assets first, and I want to list out my liabilities, and I want to list out my owner's equity, or the A-L+OE. Why do I want to do it that way? It is because the last thing I'm going to be asked for is a balance sheet. And if I do my trial balance, so right here, this is BTCI, trial balance. When I do that, I'm going to be able to create my balance sheet that much quicker. So right here, I'm going to have my assets. Are right here, I've got cash. My cash balance was 176,000. Common stock is part of owner's equity, so I'll do that a little bit later. I've got my lease deposit here. My lease deposit was 2,000. I have prepaid insurance, which is also an asset of 3,000. I have equipment, which is 10,000. And if you've taken accounting before, I don't really want you worrying about how we go through and order assets in terms of liquidity. I'm more concerned that you get the bigger concepts first. My next asset account is a loan receivable. My loan receivable was 4,000. And then I have an inventory account for a total here of $8,000. The next thing I'm going to do is I'm going to list out my liability accounts. So common stock is part of owner's equity. I'm not going to worry about that. My first one here is note payable. My note payable was a credit of 8,000. Right? Notice here I'm putting this on the credit side. Over here, my loan payable was 30,000. My unearned revenue is 7,000. And then my accounts payable is 8,000. Lastly, for my owner's equity, I'm going to have common stock of 150,000. So to make the trial balance, what we're doing is we're taking the ending balances of all of the T accounts we just created, and we're putting this into one trial balance. When we do the trial balance, I want to set this up where assets, liabilities, and owner's equity. And we're going to see why we're going to be doing that in just a moment when we go to prepare the balance sheet. So right here, I've got total debits of 203,000, and I have total credits here of 203,000. So when I look at this right here, it looks like I'm on the right track, meaning that when I look at my trial balance right over here, where my assets equals my liabilities plus my owner's equity, my total debits equal my total credits. So I'm ready to go through and to prepare a balance sheet. Okay, what exactly is the balance sheet? It's the grand equation. What we're proving is, and if you remember going back to the different companies we were looking at previously, here we got the Home Depot, my total assets are equal to my total liabilities plus my owner's equity. So we got 46.2 billion is equal to 46.2 billion. And when we go through here, when we're doing our balance sheet, this is what we're proving. So, and we're doing a very simplistic balance sheet. As you go through accounting, you're going to be doing something that's a little bit more advanced, but for right now, this is where we are. When I prepare a balance sheet, I want to start with the company name, or BTCI. I'm going to call this balance sheet. And then what's very important when you're doing the balance sheet is I'm going to say as of the date of the balance sheet, or 12/31/19. So when I do the balance sheet, I'm essentially listing out all the assets. So here I'm going to have assets. I'm going to list all these out. This is going to give me my total assets. Then I'm going to have my liabilities. I'm going to list out my liabilities. My total liabilities. I'm going to have owner's equity. I'm going to have my total owner's equity. Then I'm going to show my total liabilities plus owner's equity. Now, in terms of how you prepare this for your teacher or wherever you're doing it, there are many different ways to do it. Here you've got, like, again, there's lots of different ways to go through and create balance sheets. I always loved walking into classes where I was substituting, and I'd be getting yelled at for doing something. But look, the reality is everybody does it different ways. So here with the assets, I'm just going to go through and list them out. I've got cash, I've got lease deposit, I've got prepaid insurance, I've got equipment, I've got loan receivable, and I've got inventory. And then right over here, so when I go through here, and my total assets are going to be equal to 203,000. Notice here, when we do a balance sheet, do not, and I repeat, do not write debit or credit up here. I will thrash your exam. Look at this right here. If we look at the example of another publicly traded company, right here, if we look at Snap, right, do you see a debit credit here? No, we don't do that on the balance sheet. Don't do it. I'll be seeing you in my class again, and trust me, you just want to take this class once. Okay, so I need to prove that my total assets are equal to my total liabilities plus my owner's equity. So here for my liabilities, I have a note payable, loan payable, unearned revenue, and then account payable. My note payable was 8, loan payable was 30, unearned revenue was 7, accounts payable was 8. So my total liabilities are going to be 53,000. Again, why am I indenting here? it's easier for you to see it this way. So come down to my owner's equity. All I have here is common stock at 150. My total owner's equity here is 150. And my total liabilities plus my owner's equity is going to be here 203,000. Now, most of the times what you'll want to be doing here is we're going to do a bottom line, and then we'll make it. Let's see if we got that double line. There we go. Wow, looks great. So that's what we would be going through and doing, like, most of the time, is doing like essentially like a double underline here to denote like the final balance. But, you know, again, depends on your instructor. So right over here, this is how we're going through and doing the balance sheet. Notice that if I set up everything like this on my trial balance, the balance sheet was much easier to go through and do. This is a very simplified balance sheet, but if we look at this, am I showing that my total assets are equal to my total liabilities plus my total owner's equity? And that answer is yes. So thank you for joining me on this longer journey today. All I can tell you is that the most important thing you can be doing is practicing. The more you do questions, the more you do problems, the better off you'll be. Use the T theory account. Very, very important. Go back and look at the answers. When I tell people to go through and when you're studying the accounting, it's a matter of repetition. The more you write it out, the better off you're going to be. It's very important to write the numbers over and over again. That's how you learn it. If you don't see it, if you see this transaction right up here, you have to just keep on writing it down. It's really important to do, and that's how it's going to get ingrained. And if you're in one of my classes and you're not quick, I'll be seeing you in the following semester. Have a great day. I'll see you tomorrow. And please do not forget to like or subscribe, and I will see you on the next video. Thank you.